Based on the research, KPMG is one of the world-leading professional service companies. Numerous of the top companies in the world rely on KPMG for audit, tax, and consulting service. In recent time, KPMG has been involved in a scandal of misconduct in Ted Baker audit. In this case, there are some elements that influence audit quality and raise auditor liability in this company. Among the elements is professional skepticism. The element of professional skepticism is evident in the concern raised by the Financial Reporting Council (FRC) regarding KPMG audit. The next element is auditor independence and objectivity. The misconduct relates to KPMG providing expert witness service to Ted Baker result in a breach of ethical standard and loss of independence. Besides, the element that influences audit quality and raises auditor liability in KPMG is reliant on management representation.
The first one is professional skepticism. The concept of professional skepticism, as outlined in the ISA, encompasses a mindset characterized by a questioning attitude, vigilance toward conditions that may signal potential misstatements from error or fraud, and a critical evaluation of audit evidence. Developing a sense of professional skepticism is crucial, as it empowers auditors to objectively assess the reliability of financial data and identify potential significant errors during the auditing procedure. In the Ted Baker case, KPMG accepted management representations at face value without conducting sufficient independent verification. This lack of skepticism allowed Ted Baker to inflate its inventory values and misrepresent its financial position. As a result of KPMG's failure to exercise proper professional skepticism, the company's financial statements were materially misstated. Next is auditor independence and objectivity. Auditor independence, ensuring the auditors are devoid of any relationships or influence that might undermine their capacity to act with integrity. Meanwhile, objectivity denoting the auditor's capability to sustain impartiality and lack of bias when forming judgments and conclusions during the audit process. In the Ted Baker case, KPMG compromised its independence by providing expert witness services to the company in a commercial court case. As a result of KPMG's lack of independence and objectivity, the company's audit quality was compromised. This dual role created a conflict of interest that made it difficult for KPMG to remain objective in their audit of Ted Baker's financial statement. Lastly is reliance on management representations. Relying on management representations is a customary auditing procedure wherein auditors seek written or verbal statements from the management. In the Ted Baker case, KPMG failed to conduct sufficient independent verification of management's claims and they accepted management's explanation for accounting irregularities without questioning. As a result, KPMG was unable to detect the accounting irregularities that Ted Baker has committed. Auditors should not rely solely on management representations, and they should be diligent in conducting independent tests of the company's record.
Assalamualaikum and hi. Element impacts auditor exposure to liability. First, auditor independence and objectivity. KPMG fails to maintain an unbiased and impartial stance or compromise ethical standard in conducting its auditing works. Due to this transgression of ethical standard, KPMG independence with regard to the audit was lost. As a result, the company lost over 80% of their value. The share was down. Ted Baker had experienced difficulty with sales and profitability. The issue also captured the interest of large sum of money. The profit expectation for Ted Baker has reduced that year. Any conflict of interest or lack of independence can lead to legal consequences. Failure to exercise professional due care. During the audit, the KPMG team fails to conduct throughout the procedure and review process. They overlook the key internal controls and do not perform sufficient substantive testing. As a result, material misstatements in the financial statement go undetected. The failure to exercise professional due care is another critical element that can expose auditor to liability. Auditors are required to perform their audit with a reasonable level of skills, care and competence expected of a suitable qualified professional. If it can be demonstrated that the auditor did not fulfill this duty and that their negligence contribute to financial misstatement going unnoticed, the audit firm may face legal consequence. Stakeholders such as investor or regulatory bodies could pursue legal action based on their failure to meet professional standards.
Assalamualaikum. I am Adilana Devanti Azrimi, 287967. I would like to continue with the analyzation of the factors that give an impact on audit quality and auditor liability. So the first one is audit quality. Based on KPMG and Ted Baker case, there are some of the factors that give impact on audit quality. The first one is the auditor's independence and objectivity. The act of auditors is critical for ensuring the audit processes integrity. Any conflict of interest or undue influence from the audited firm could compromise auditor independence. So, For example, according to the misconduct action taken against the corporation, KPMG was accused of lacking objectivity and integrity while auditing the Ted Bkaa company's financial account. Next, the oversight of the audit firm. The culture of an audit company is critical, with a particular emphasis on ethical behavior. For example, KPMG provided witness services to the audit firm, Ted Bkaa, in violation of the ethical requirement. In this case, the audit company must urge the audit team to act and perform their duties ethically in order to ensure that the audit quality remains steady. Lastly, auditor competence and training. Auditor competency is an essential element for audit effectiveness, involving a commitment to continual learning and remaining current on industry innovations. Auditors must understand financial reporting requirements and industry-specific complexity in the evolving world of accounting and auditing standards. For example, according to the business assessment of the matter, KPMG was found to have committed wrongdoing by providing witness services to the audited company. Moreover, there are also some impacts that affect on auditor liability, such as risk assessment and management. Effective risk assessment is a critical component of the auditing process, helping to detect and prevent possible risks that might threaten the auditor's standard of to personalize their audit strategy. Auditors must extensively examine the risks associated with the client business. In the matter of KPMG versus Ted Bkaa, a KPMG partner was fined 80,000 for confessing to unethical behavior during the financial statement and account audit. Besides, the communication with the stakeholders. Communication with stakeholders is an important component of the auditing profession. Based on the KPMG and Ted Bkaa case, the auditor does not communicate with the client properly about the material misstatement that has been found in the financial statements. Finally, the quality control procedure. The development of strong assurance system inside an audit company is critical to maintaining the integrity and dependability of audit engagement. On the case, KPMG did not improve its internal quality control method to ensure the audits are carried out in accordance with recognized professional standards. So, based on all the factors, the ones that have the greatest impact on both audit quality and auditor liability are the auditor independence and objectivity and the communication with the stakeholder. This is because the main objective of auditing is to obtain reasonable assurance about whether the financial statement as a whole are free from the material misstatement, either due to the fraud or errors. That's all from me. Thank you.
Now, I am going to present about the recommendation on how to ensure audit quality and reduce auditor liability. For the audit quality, we recommend to highlight the auditor independence and objectivity. In this context, independence and objectivities are very important to build up the public confidence in the integrity of the accounting professions. For example, KPMG has been accused of lacking objectivity and integrity in the process of auditing the financial statement of the Ted Baka's company. So, we can say that it is important to make sure that audited company and auditors are separate entities. For the next recommendation is continuous enhancements and improvement. It is because to determine whether the chosen strategy are right and produce positive or negative outcome for the decision. For instance, KPMG has made the decision to stop providing witness service for any audited company, so it can be guaranteed proper execution of the auditing process and lower unexpected risks. Next, we move to the recommendation on auditor liability. The recommendation is enhanced communications and transparency. This is because it may contribute to building trust between an auditor and audited company. For example, KPMG as an auditor will take action to properly express any issue regarding the financial statement from the Ted Baker. By this step, the information will be shared and can identify any areas that need improvement.
In conclusion, KPMG, a prominent professional service company, faced a scandal involving a decline in audit quality, notably highlighted by the Financial Reporting Council. Elements that impact the audit quality of the financial statement are lapses in professional skepticism, auditor independence, and reliance on management representation. Besides, the analysis of the factor of audit quality and auditor liability in the KPMG and Ted Bkaa case, auditor independence and objectivity, along with effective communication with stakeholders, have the most significant impact on both audit quality and auditor liability. Recommendation on how to ensure audit quality and auditor liability is auditor must emphasize independence, maintain a robust code of ethics, and continually strive for improvement to guarantee audit quality.